Hello, and welcome to the Connect Ship, iShip Reach webinar, Trade Pessimism, Technology Optimism. My name is Julie James, and I will be the moderator for this webinar. Attendees, you will be muted for the duration of our webinar. However, you can submit questions at any time throughout the webinar in the QA window of the Zoom application. Once our speaker has finished, we will address as many submitted questions as we can. The Reach webinar series is a way for industry experts to share trends and solution ideas about logistics. Today's discussion will be led by someone who analyzes important changes in the industry for the Journal of Commerce. Eric Johnson will provide industry insight into the history and future of trade tariffs and the possible impact to shippers of expected fuel increases and the emerging technologies to follow. Eric Johnson is the Senior Editor of Technology for the Journal of Commerce. He leads coverage and analysis of the impact of technology on global logistics and trade. He reports on how shippers, carriers, and logistics companies use software and presents new concepts impacting core freight transportation processes. Eric spent 13 years with American Shipper in a variety of roles prior to joining the JOC in May 2018. He holds a bachelor's degree in journalism from the University of Wisconsin and a master's degree in international business from the University of Leeds, UK. He has lived and worked in Southern California, the UK, and India, and now resides in Washington, D.C. Please join me in welcoming Eric Johnson.
Thanks, Julie. Really excited to be here today and got a lot to walk through and looking forward to everyone's questions on this. First of all, I just wanted to sort of give a little bit of the lay of the land, background on myself beyond what Julie had mentioned. As she had highlighted, I am with JOC, Journal of Commerce, and cover technology and trade issues for the publication, as well as putting together a series of events that are related to the coverage areas that we cover. So a lot of the stuff that I'm going to highlight today is related to areas that we either cover in our magazine or data that we are producing that's directly feeds into our content coverage on these critical areas. So as I said, really looking forward to presenting this to you and definitely am interested in the questions you may have regarding trade and technology. So I'm going to start off with sort of the glass half empty or negative side of things, trade pessimism. It's definitely been a trying year for companies that import and export goods, a lot of it due to uncertainty. And as you can see on slide 6, there is a lot of uncertainty to be keeping track of. I'm going to take you sort of through how this all got started. We won't go all the way back to the campaign where trade was started to become kind of a topic of real interest for not just our industry, but really into the mainstream. But so I'll start with sort of where the tariffs got kicked off and how this has sort of mushroomed into a fairly big deal for importers and exporters. So it really started off earlier this year in 2018 with some tariffs that went into effect on washers and solar equipment. And by the way, everything that I'm going to be talking about today in terms of tariffs, we relate to kind of containerized shipping. So you might come across a couple of terms that you may not recognize, and happy to answer any questions around that. One of them is TEU, and that means 20-foot equivalent unit, which is a unit of measurement that we use and the industry is widely uses to keep sort of metrics around container volume, containerized goods volume. So we started looking at this through the prism of how are tariffs going to impact containerized volume. And so that's what you sort of see on these bullet points is how much volume and what percentage of that volume is going to be impacted or has already been impacted by tariffs. So as I said, it started with washers and solar tariffs. It soon grew to something that's captured a lot more of the public's attention, which is steel and aluminum tariffs. And these were tariffs imposed under a couple different statutes in trade law that were intended to sort of foster growth in the steel and aluminum industries. And that's the steel and aluminum manufacturing industries in the US. You may or may not have read a lot about this. It's caused a lot of confusion, consternation, acrimony amongst importers and exporters, but also companies in the US who rely upon steel and aluminum parts that go into their manufacturing, or components that go into some other good that they manufacture. I think some of the ones that have come up a lot are things like the steel cans that soup goes into, beer cans, but there's an unending list of uses for steel and aluminum inputs. So what we've really seen is that these tariffs have had sort of highlighted the extent to which supply chains are complex. They require a lot of coordination, and a lot of times even if manufacturing is happening in the US, they still require inputs from outside the US. So those initial steel and aluminum tariffs, which went into effect earlier this year, we calculated at IHS Markit, which is the parent company of JOC, calculated that those amounted to about 1.2% of US imports. So not a huge volume, but significant to those industries it was impacting. Then we started to see the sort of trade war, so to speak, impacts, where China started to retaliate for those tariffs with hitting markets that were important to us in terms of exporting to China. And let me backtrack also. Those steel and aluminum tariffs actually were not just related to China. They were related to any country in the world that was exporting steel and aluminum to the US, with the exclusion of some countries that successfully lobbied the US to be excluded from that list. So after China, we saw the EU, India, and Turkey also retaliate against those tariffs. There has been some positive movement in terms of US-EU discussions. In August, there was some work, or at least some discussion, between the Trump administration and the EU around zeroing out some tariffs. But for now, those are just talks. So it's a lot of uncertainty still. And there's still a lot of uncertainty around when or how those steel and aluminum tariffs might be lifted or mitigated in some way. Right now, they are in effect, and companies are having to sort of respond as if they are not going to go away. So those are the steel aluminum tariffs. Those are things that were impacting the globe and really all of our trading partners potentially. Then there was another set of tariffs that the Trump administration enacted starting in July. That impacted imports directly from China. So these are tariffs related only to the Chinese market. And as you might imagine, given our reliance on imported goods from China, these are having a bigger impact. We estimated at IHS Markit that it accounted for about 7% of US-China container trade, those $50 billion of tariffs. And just to put a little more detail around those, that $50 billion was separated into two tranches, a $34 billion one initially that went into effect in July, and then another $16 billion that went into effect just last month in sort of late August. In addition to that, there's been another $200 billion of tariffs announced in July that are due to go into effect at some point. Those are sort of going through the works right now at the U.S. Trade Representative Office, with companies applying to be potentially excluded from those $200 billion worth of imports that are being targeted. So it's a big kind of uncertain ordeal for a lot of importers to figure out whether their particular goods are actually, might be impacted by this next set of tariffs that has not yet gone into effect, but looks likely to go into effect. And that now you're talking about close to half of import trade volumes with China being impacted. And then to add further to that, just in early August, right around Labor Day, President Trump said he is seriously considering another $247 billion in addition to the $50 billion already in effect and the other $200 billion that is pending. So that's now we're talking close to $500 billion, which is pretty close to all of U.S. import trade with China. So we're talking about virtually every product that we import from China being impacted by these tariffs. So the rebound effects of that are China is obviously not sitting idly by and letting us tariff their goods and not responding in kind. So they have, like they did with the steel and aluminum tariffs, they've tried to retaliate in ways that impact markets that are important to us, export markets to China that are important to us. So that, has focused primarily on ag because tends to be what we ship. So by the way, China has not yet retaliated for the looming 200 billion. I would imagine they are in the midst of drawing up lists for ways to do that when those go into effect, but I think they're waiting until they actually do go into effect. So all of this is creating a scenario where importers are worried about, whether their finished goods or their components are going to be tariffed at what rate, and exporters are worried about the retaliatory impacts of those tariffs and whether their goods will be sort of targeted by China or other trading partners that we have applied tariffs to. I wanted to highlight, aside from the tariff issue, and another element of this is NAFTA, which it probably deserves a whole other podcast or webinar unto itself, but that is certainly, kind of in the works and renegotiation and could have huge impacts in terms of North America serving as a single market for supply chains. But another sort of global impact on trade that hasn't been getting as much attention as the tariffs is bunker prices. Bunker is the fuel that ocean carriers, shipping lines use to run their vessels. And after a few years of relatively low prices, we started to see at the end of 2017, beginning of 2018, prices starting to go up. And bunker is the single biggest operating cost to shipping lines. So when the cost goes up, it severely impacts ocean carriers' ability to get a decent margin on the service they provide. So the thing to be mindful of as a shipper that is relying on ocean freight is how does that impact my rates if I'm directly contracting either with a carrier or with a intermediary? Is that going to rebound back on me in terms of what I am expected to pay? Some of the bigger shippers, big volume retailers that have direct contracts with carriers are able to negotiate out any sort of fuel surcharge at the beginning of their contract. And so then the question becomes, for companies that don't have those types of relationships, will the carriers try to sort of recapture some of the costs they're losing on increased fuel costs through their other customers that they are able to charge surcharges to? So something to be really mindful of. And then another fuel issue that has really been flying under the radar for everyone sort of outside the energy industry, but it could be incredibly impactful in about 15 months from now, is a mandate by an organization called the International Maritime Organization, which regulates global shipping. And starting in 2020, they are significantly increasing or decreasing the amount of sulfur that's allowed in bunker fuel. And what that's going to do is create a situation where shipping lines are going to be paying a lot more for the fuel that they use to run their ships. And we're not talking about like minor fuel increases that are sort of, inherent in all sorts of fuel markets, like the gasoline that we pay for at the pump or diesel fuel for trucks. We're talking about a major cost impact that they really just cannot account for. So the forecast is that this is going to cost anywhere from 5 to 100 billion. I would suspect it is not going to be on the lower end of that. Because if you look at Maersk Line, which is the biggest liner carrier in the world, biggest shipping line in the world, they have already said that it's going to cost them $2 billion annually to comply with this new mandate. So it's going to be costly. There's about anywhere from 12 to 20 kind of major global shipping lines. So if you kind of extrapolate that $2 billion cost to their bottom lines, it's quickly a multi-billion dollar cost for the industry to absorb. and they aren't going to absorb it. They're going to really try. They have to try to transfer this cost burden onto shippers. Sorry. So, that's really going to impact almost every shipper, whether it's a large volume shipper like a major retailer that's been the traditional kind of cornerstone of ocean carrier business, all the way down to the rise of e-commerce, cross-border e-commerce shipments that may be traveling on an ocean vessel at some point. They're going to be hit with costs as well on this. So this is really something that every shipper of any size is going to have to be mindful of. So another thing I'd point out on this particular slide is the chart to the right showing kind of by region where IHS Markit expects compliance to be sort of high or low. And as you can see, most of the developing economies in the world, the risk is slightly higher to a lot higher that they will not be able to be in compliance. And this is going to have, we haven't even really uncovered all the impacts that this might have, because it's still, everyone is still in the midst of trying to comply with this. But you can think about the big issues being source of this fuel, which is unclear right now, infrastructure to provide this fuel to the ports where carriers need to fill their vessels compared to how they fill their vessels and where they fill their vessels now. So you may see some changes to their networks that go into place so that they can comply with this mandate, and you may see them having to avoid regions where they don't think they're going to be able to fill their vessels with this fuel that they need to be using. So, and there's big questions about whether the industry is even going to be able to comply with this as a whole by 2020. So something definitely to be mindful of. And this slide, the next slide on this low sulfur fuel mandate kind of goes into this in a little more detail. There's definitely concerns that both carriers, in terms of their ships being able to use this fuel, and refiners, in terms of being able to produce the fuel, are going to be able to sort of meet the mandate from a commercial perspective. There are some other concepts out there like scrubbers that clean the fuel before it's actually emitted. So there are some flexible ways, but none of them are cost free, and none of them are easy to implement. So one other area that I would highlight in terms of kind of global trade uncertainty is something that went into effect earlier this year that also, again, might be flying under the radar but has an impact on kind of trade flows, is China started this environmental push at the beginning of 2018 to scrap imports of US waste paper. And this is really key because waste paper is one of the biggest, if not the biggest, export commodities that we ship to China. So you're talking about sort of China not accepting one of the biggest commodities that we have traditionally exported to them. And that has an impact both in terms of the companies that export that waste paper, finding alternative markets for it, but also in terms of equipment availability, because what happens is the move of waste paper exports back to Asia is what's known as the backhaul, the less lucrative, less valuable part of the trade. But the key part of it is that it provides some revenue while carriers are getting containers back to Asia so that they can be filled with more lucrative trade that's headed back to the US. So the question for carriers then becomes, ocean carriers that is it better to just ship containers empty than to search for some other commodity to fill those containers with some other export commodity? And then for those particular exporters, the question is, where are there any other markets? China is a very difficult market to replace, if not impossible in some ways. There are some other markets for waste paper, but nothing as big as China. So it's really sort of tipped that market on its head, and it has some interesting impacts to the rest of the market from a trade network and trade flow perspective. And then other markets in Asia are sort of taking similar steps as well, including Vietnam and Thailand and Malaysia. So other outlets for that particular market. and then, that's driven down prices for this product in the markets that are accepting it, because there's just less competition for the goods. So there's fewer people to sell to. Obviously, price goes down. So as I said, this has really tipped this market on its head. So just kind of tying a bow on all this, you have NAFTA up for renegotiation, currently being renegotiated. You have tariffs being assessed on steel and aluminum, as well as some other specific goods. And then you have potentially almost all imports from China being tariffed to some degree. It's creating a lot of uncertainty for shippers. And as I mentioned earlier, this goes from the biggest volume shipper from Asia to the US, all the way to an occasional shipper, or someone who might be considering whether they can transfer parcel shipments to ocean shipments and then stage them in the US, and then do kind of like final mile in the US. So all of these tariffs are having kind of rebound effects on other markets, and not just directly on the things that are being tariffed. So it's causing tremendous amount of uncertainty. It's really causing everyone to look at how their supply chains are oriented, where they source from, and how that's going to impact downstream kind of fulfillment to their end customers. And these tariffs don't look like they're going away anytime soon. So it's also, I think companies are starting to now go from, okay, we need to get over this time period, to, all right, now this is going to be the norm for a while. So how do we sort of manage that from a strategic perspective? So let's move to the glass half full side of things, and talk a little bit about tech, and why there's a lot of optimism around tech in terms of global trade and logistics. What I'm going to do is walk you through a few technologies that I think are interesting, and that I hear a lot of questions about, and maybe hopefully explain those to you in a way that is a little bit easy for you to understand, and serve as a launching pad for you to study them more. And the goal is to help you think a little bit around whether there's better ways to strategize around moving freight. There's a bunch of cool technologies out there that are existing, and then some ones out in the future that are really going to change how shippers think about like which mode they use, whether you can shift down to a more costly mode that might be more effective because you can manage it a little bit better now, and you get better visibility from it. So I'm going to start with one that probably everyone has heard a little something about, but you may not have a good idea about what it means, and that's blockchain. This is probably the question I've gotten asked about the most this year. And it really is a tech with probably more questions than answers at this point. I've listed a few of them here, but I think these are key. We did a big piece in June trying to give a lay of the land of where blockchain in logistics is right now. Just to be really clear up front, there's a lot of discussion, and it's rare that I talk to a technology provider or 3PL that is not at least considering what blockchain means to them, if not actively piloting or testing some sort of application in with their customers or across some process to see if it works for them. So here are some of the key considerations when you think about what blockchain is. The question is, who owns the platform? Is it a carrier, whether that's an ocean carrier, whether it's an integrator like a UPS, whether it's a shipper? So BCO is a term, beneficial cargo owner, that we use to sort of designate the consignee or the shipper of record in the U.S. when importing, or the shipper in another location that's importing from the U.S. Or is the solution going to be owned by the software vendor? So is the vendor going to be kind of the neutral party that everyone goes to? The other thing is, who pays the cost? And I think this is a really key one. Blockchain, from everything we've been told, is expensive to build. At this point, it's expensive to build and it's expensive to operate. So that cost has to be absorbed by someone. And is it the end shipper that it benefits? Is it the service provider that is providing a service and getting some other sort of transactional fee and is absorbing the cost of building this? Is it the carrier? Is the data and the data accuracy that is proposed to be better in blockchain? Is that a value big enough to kind of absorb a cost to build this? These are all questions that are sort of hanging out there. The other thing is to think about is we have existing, what I would call distributed databases. So, or web portals that everybody can get access to through a password and a username and some sort of encryption. So we have those sorts of environments. And so I think the blockchain community, it's sort of incumbent upon them to sort of explain why what they're doing is better and different than what exists today. And that feeds into I think a big question that this is a term that you may or may not have come across, but it's one to keep in mind, because this is kind of the key area to explore in terms of whether blockchain is going to be adopted by the logistics industry. And that is whether they are permissioned or permissionless. And that means permissioned is sort of similar to the web portal that I just discussed before. There's a different sort of mechanism to get into it, but I have been invited, or I have asked for access to a database or some sort of application because I need to extract information, or I need to add information, or both. And the person who's administering that, or the set of companies that are administering that, give me access to it. That's sort of the typical setup. If I'm a shipper and I have a system, like say a visibility system, I want my 3PLs, I want my carriers, I may want some suppliers, I may want some customers to have access to that or provide data into it. That's a permission sort of structure. Blockchain, the advocates who are really advocating for this technology say, well, permissionless, where there's not that sort of same restrictive things, and there's other ways to sort of verify the identity of the party that is adding data or extracting value from this. That's sort of the ideal use case for blockchain. And if you just build permissioned blockchains, then you're just sort of replicating, systems that exist today, and that they're maybe incrementally better, but not light years better. And so then what's the point? And so the big question is, does that permissionless setup, which you may have heard of, obviously Bitcoin is sort of the most famous case of a permissionless blockchain. Anyone can access it. It's public to everybody, but the whole community kind of keeps track and secures the platform and secures the veracity of what goes on in the platform. So does that sort of structure mesh with supply chains? Are shippers and 3PLs and other entities going to have inherent trust in the system, or are they going to kind of fall back to this thing where I only trust the party if I know them some sort of way outside of the system? So I've just put a few kind of use cases that have been thrown out and are being tested today. One is, a central data repository that everyone can kind of trust. Product provenance, this goes back to like product tracking, and if there's a product recall, you can kind of go all the way back and figure out exactly where some sort of problem occurred. Trade finance is a big one, and one that I tend to think is quite compelling because it relates to dollars and cents, which is always a motivator. So could you, for instance, use a blockchain to eliminate a letter of credit by providing an alternative mechanism to trust someone that you want to provide credit to, that you ordinarily or otherwise don't have trust in? There's some interesting solutions out there around visibility and proof of delivery that are related to blockchain and tokens, crypto tokens that are kind of associated with those blockchains, and then basically just creating electronic versions of documents that are currently basically produced in paper versions and couriered around the world or sent via email. And is there a better way to kind of put these all in one place for everyone to create and submit them? So those are just some of the things that are out there. And moving on to the next slide, I'm not going to belabor this too much. We could easily do a 3-hour podcast alone on blockchain or a webinar alone on blockchain. But just a couple things to think about more broadly about the technology. Blockchain in and of itself does not exist. It is reliant upon other technologies, the web, APIs, which are application programming interfaces. Those are that's a way for systems to talk to one another. The other thing to think of is blockchain really only derives its value from when there's a certain community attached to it. So if you and I transact on a blockchain, it's less valuable than if 10 of us transact on a blockchain and if 1 million of us transact on a blockchain. So there is a critical mass component to this. And then, as I mentioned kind of before, think of blockchain as a value transfer mechanism. So we always think of value in terms of money, but blockchain really, one of the interesting things is it allows you to think about things that could be passed back and forth between organizations that aren't money, but still have value. So is it valuable for me to give you a certain piece of data? Or as a carrier, is it valuable for me to offer you some capacity, in exchange for something? Services, premium services, all of these things can be assigned a certain value in blockchain and transferred back and forth between organizations, depending on how much they are worth to the other entity. So that's really kind of like the higher level of blockchain when you get into especially the more permissionless or public blockchains where these types of things can happen. One thing I would really recommend is not to get too bogged down into how blockchain is sort of put together. Sort of leave that to the engineers. Just think about what you can possibly do with a blockchain solution, and don't worry about like how it's constructed. We don't think about, for instance, how websites work. We just click in the URL and let magic happen. So we're not there yet with blockchain, obviously, but I would definitely, unless you have an interest in it, I wouldn't get too bogged down by how these things are constructed. And then just some advice to kind of take away from here later on in terms of when you're considering or if you're considering adopting or piloting some sort of blockchain solution. And that, there are solutions all the way from the parcel side all the way to, big volume ocean shippers. So there's really air freight, everything. There's pilots going on all across the board, and it does not take a lot of work for a shipper to say, hey, or even a 3PL to say, hey, I'd love to try one of these things out. You'll have a whole list of people wanting to work on that with you. So I'm going to move on to tech that I think is actually a lot more in the here and now. It's still not obviously completely mature yet, but we actually do see AI, artificial intelligence, and machine learning. These are things that are actually being incorporated right now into solutions. I would be careful to, sort of blindly trust anyone who is saying that we are doing X and Y with AI and machine learning. It is definitely a buzzword that everybody on the tech vendor side is trying to use to show their relevance and sophistication, but not everyone is doing things with AI and machine learning, but there are definitely companies that are doing things with AI and machine learning. And I think what I would just say is similar to blockchain is this is really heavy stuff. It's heavy duty mathematics and programming. And even a lot of people who are in this business, in this side of things, don't understand it completely. And they will admit that they don't yet understand all the implications of it yet. But leave it to those people and think about what some of these solutions can do for you rather than getting too bogged down with how they work. And I've just listed sort of the sequence of where this is going. One is, and this is definitely happening now, you're seeing AI and look at patterns and say, what's going to happen in the future, predict what's going to happen in the future. The next phase is, and this is becoming more commonplace, is they will suggest a course of action to a human to undertake in terms of picking the right mode. Maybe it makes sense to ship something parcel versus LTL, or LTL versus truckload, based on some patterns in one or more of those modes in the region that you're shipping to and from. So there's a ton of different variables that could go into a machine learning algorithm that would help a human make a decision about this, but ultimately the decision would still be the humans to make. The next stage of that, and I think the thing that is sort of worrying to people in our industry, both from a job number perspective and also from is this the right way to handle this, is have the machine look at patterns, predict a course of action, and then execute that recommended course of action. So that's another stage that we're really not at yet, but that people are theorizing about. And so then the question becomes, are those effective, and what does that mean to the future of sort of work in our business? And I'm just going to leave you with a definition here of machine learning that I find interesting to think about, how you might think about it if you want to get deeper into the mechanics of this. So let me talk a little bit about a sort of pet topic of mine that I think is really interesting, and that's collaborative platforms. I think of this as something that is not, for some reason, capturing a lot of attention, but really I feel like should be, because we are so consumed in our day-to-day lives, both at work and in our personal lives, with messaging people, texting people, instant communication in 5-6 different channels. On a given day, I might get someone talking to me on the phone, email, text, WhatsApp, LinkedIn, Twitter, Slack, GChat. I mean, it's endless, right? So what's interesting to me is to see how in the transportation industry, we're starting to see companies try to address how to bring those communication strings into the system, and whether that means using technology that captures keywords or patterns in those established communication channels like Slack or GChat or email, and bringing them into a system. Or what I'm seeing more and more is companies that develop kind of backbone technology, transportation technology. They are bringing those communication channels, they're embedding them within the system, so making them native to the system. So that has all sorts of interesting things, because if you start to communicate with all the parties related to a shipment within the system where you procure and plan and execute those shipments, all of a sudden that data becomes very structured and it's very usable. So you can start to pick up even more patterns about where things are happening, and dynamics that might inform a different execution decision the next time around, or it may influence where you procure or source from, or whether you use parcel versus LTL again. So there's all sorts of interesting things that are going on in this regard, and some of it is happening, as I said, where it's being embedded within the system. More and more, though, people are realizing so much of our communication happens outside of a system. Is there a way to capture that, either through an algorithm that can recognize patterns in emails and bring that into a system, and even all the way up to capturing spoken word discussions over the phone and structuring that and bringing that into a system that recognizes patterns. So to be clear, don't feel like you're behind the curve if you don't have this capability yet, or your provider doesn't. We're still early in this game, but just keep on the lookout, because I think you're going to start to see more and more of this. And that sort of leads into where we see TMS going. TMS is not a new thing. It's been, there have been permutations of TMS for more than 30 years. But it's an interesting time in this market right now. It's a hugely competitive and fragmented market on the domestic side. You have TMSs of every shape, size, flavor, cost level. You have TMSs that purport to be able to be implemented in a day. You still have big, heavy-duty TMSs for big global shippers that take months and months to implement. You can have it hosted in a cloud. You can still have it where you are managing it yourself through your own server. So what's really been interesting is TMS used to only be available to a certain set of shippers, but now if you're a small shipper but with complex needs, and you don't have a lot of volume, but you need some system to help you manage that, there's probably a TMS for you that is not too costly and is easy to kind of learn, and it's not too disruptive to your processes, and will reduce your freight rate and reduce the amount of time you spend managing those shipments. So that's really been the interesting thing. You know, I mean, we've seen an explosion in parcel-related TMSs. So whether those are standalone systems for pure parcel shippers, or even the biggest shippers in the world need to also manage parcels. So does it make sense for them to be able to manage that in the same system as they manage ocean freight and trucking? Yeah, you're starting to see that, where they say, I want one system where I can manage across modes and make decisions between modes. The other element I'd mention is that we really see sort of there's been a new dawn in the last few years of software partnership, where you see, instead of a TMS vendor saying, I need to buy every single small vendor that I need data from, or every small vendor in a region or mode that I don't have, instead of going out and trying to absorb those or build it themselves, they're working with more and more in a partnership basis or an integration basis with interesting niche providers. So if I buy a certain TMS, I may get access to all these other systems that I didn't necessarily go out and adopt myself, but I get them through the system that I did adopt. And that's really expanded the reach of these systems to tackle all sorts of issues and different modes and regions. And for the consumer, the shipper, or the service provider that is using that TMS, you all of a sudden have this extension of your system to do all these interesting things that you didn't even plan to do. So it's really quite an interesting development, and that's really reaching across all modes and regions, as I mentioned. So one last slide to present today is what we see as sort of the changing dynamics in domestic freight. And I think there's been an explosion in logistics technology the last 5 to 10 years, backed in large part by a lot of venture capital money and even private equity money flowing into this market. They all see inefficiencies that can be addressed by technology, and nowhere has that been more evident than in the U.S. domestic freight space. There's just been so much money, billions of dollars really, flowing into everything from last mile delivery services all the way upstream to managing ocean freight on a global basis. So the domestic side of things has really been where a lot of this stuff has emanated, where a lot of the original kind of players, startups, have been getting money. And I think nowhere has that been more interesting than trying to unlock capacity that shippers really need right now, because it's quite a tight trucking market in the U.S. And obviously that has rebound effects on, from LTL truckload down to LTL, LTL potentially down to parcel if there's not enough space on the trucking side. So the dynamics of the market are impacting really all modes. But technology has the ability to kind of not only help companies optimize among those modes, but also find capacity that may have been sort of hiding in plain sight before there was a technology solution to address it. And we see that a lot in load matching. So we're seeing a lot of dynamic load matching solutions come up, and those are based on the idea that if I know where all the trucks are, and I know if they have a load or not, and on the other side, if I know what loads are available from a shipper or a broker, if I can match those on a platform, a lot more complex, but similar to the way that Uber matches my need to pick up get a ride from one place to another, and there's a driver who happens to be in that area. It's the same basic concept. It's just a lot more complex on the trucking side. So that's really unlocked a ton of latent capacity out there. And some of the ways that that's happening is through ELDs, which are electronic logging devices. These are now devices that have to be on every single truck in the U.S. And soon Canada. Canada is unveiling its own regulations around that. And GPS, meaning the location of a cell phone in a driver's hand, all the way down to cell phone triangulation, which is a little bit less precise, but has been up until now a lot more commonplace in terms of finding out where trucks and loads are. So that's a sort of way to figure out where a cell phone that is not actively using an app is at any given time. Whereas the GPS one is through an app that a driver downloads on their phone, so you can track exactly where the phone is at a given time. All the way down to physical sensors, and this is something we're seeing. It's not anywhere near pervasive, but for high value goods, we're definitely seeing, or goods that have to be temperature controlled or resistant to light, those sorts of things. We're seeing a lot more use of physical sensors. So all these things contribute to a better picture of where trucks are, where capacity is, where loads might be able to fit with that. So that I think the thing to think about if you're looking at things like this to augment whatever else you do is the vendor that's providing visibility for you, are they also providing load matching, or vice versa? Is one a bridge to the other? Just something to think about as you sort of enter into some of these agreements or partnerships. And then, if you're a shipper and you're managing parcel and LTL and truckload and other modes, are you going to be asked to sort of tap into a bunch of different systems, or is there a way to use a system? Maybe it's a TMS, maybe it's something that your service provider or software dashboard that they provide you, but one single source where you can kind of manage that. I think that's going to be kind of the thing that shippers are going to seek out the most, rather than having to log into several different systems to keep track of everything. So yeah, with that, I know I threw a lot of stuff at you, and definitely eager to hear whatever questions you may have. But thanks again for the time, and appreciate ConnectShip for having me on today.
So what are some of the ways our audience members can continue to follow and contribute to the blockchain in the supply chain conversation?
Yeah, this is an interesting, I think, topic right now. A lot of what you hear about in terms of whether blockchain will be truly adopted in the supply chain or more narrowly in logistics and freight and goods movement is, do there need to be some standards set? And what do those standards look like? And who's going to be kind of contributing to the development of those standards? It's not entirely clear right now. There definitely are some organizations that are out there trying to kind of coalesce around a certain set of standards when it comes to blockchain. From my understanding, those are either just starting, just getting off the ground, not making a ton of progress at this point, but we're still very early. I think probably what's more likely is you have one or two or three solutions that start to emerge that get kind of critical mass within their area. So maybe there's a parcel blockchain application that customers start gravitating toward, and the standardization kind of happens by commercial or market forces rather than a group of people determining what it should look like. There's also, and this is probably not to be understated, there is a lot of attention being paid to blockchain on the regulatory side. So you may have governments saying this is what a cross-border parcel blockchain needs to include, or what it needs to look like. Or they may be, developing a regulation that counts on a blockchain. So maybe you have to file any customs form in a blockchain in 10 years time or 5 years time. And the standards are just sort of set by the government rather than on the commercial end. But I think what's probably difficult, and I realize I'm not giving people necessarily a direct way to go, but if you go online, just look for blockchain organizations, blockchain associations, blockchain standards. There's lots of different groups out there. What I will say is there's no definitive group that is out there like absolutely setting the standards, and if you're not involved in it, you're missing out right now. We're still at such an early stage that it's almost unclear as to how that all develops. So,
right. Our next question: if you are a parcel shipper who has recently begun to get more international orders, what are some conversations that are important to have?
Yeah, so this is another kind of correlated issue to the ocean freight how ocean freight factors in with parcel. I think what we're seeing a lot is definitely smaller shippers who maybe have only had to worry about shipping domestically are now getting, and this is happening all around the world, into the US, but also in the US, having to fulfill orders to customers abroad. Is it's not simply shipping via, parcel. There's, like it is domestically, there's considerations to be had. There's customs considerations, there's language, currency, and certainly the parcel companies, the big integrators, have capabilities to kind of wrap around their parcel services, their sort of core, package movement. But if your sales start to scale and you need, you want sort of a system outside of what resides purely within your parcel capabilities, there's lots of interesting solutions out there that kind of help you calculate what your duties are, and so there's just lots of different options. But I think that's probably the first step, is work with your parcel company to figure out like what your exposure is to duties, what other customs forms you need to fill out to fulfill an order to an overseas customer, and then go from there once you start realizing how big that demand is.
All right, appreciate that. So we do have one additional question. Can you expand a bit on the TMS landscape, just in terms of the ability to manage parcel alongside the other freight modes?
Sure. Yeah, I think this has been another interesting development. I had this slide about TMS, and I can't remember if we mentioned how parcel fits in there, but what you're seeing is TMS providers that have traditionally focused on optimizing around truckload and LTL have really made strides in the last 3 to 4 years in terms of building a parcel management mode that doesn't just sit separately or alongside, but is actively integrated with especially LTL, so that you as a shipper can use that and say, first of all, manage your parcel more effectively, your parcel spend more effectively, and your engagement with carriers. But you can also start to make determinations about, well, if I have enough volume on parcel moving from point A to point B, maybe I can optimize that and move that up to LTL, and then I manage that within the same system, rather than having an LTL platform and then managing parcel either without a system or via a separate system, and there's not really well connected. So there's clearly demand, and this goes back to what I said about even the biggest shippers in the world have a significant spend on parcel because they're moving samples, or they're doing some reverse logistics, or there's spare parts and things like that that don't necessarily need to move on a container or a truck, and more they're realizing that there's opportunities to fulfill direct to customer via parcel as well.
So as I said, we know that people are going to want to get in touch with you. What is the best way for people to reach out to you and maybe subscribe to the magazine as well, to the journal as well?
Sure. Yeah. So easiest way to find my stuff is joc.com, and there's certainly a place to subscribe there. We have a daily newsletter that goes out too. That's very widely read within the freight community. To get in touch with me directly, it's Eric, ERIC.Johnson @ihsmarket.com, and that's MARKIT. I'm also really active on Twitter, so you can follow me at LOGTECHERIC, LogTech Eric. Yeah, those are probably the best ways to get in touch, and obviously happy to help anyone who's tuning in with any kind of understand anything that I went through.
Great, we appreciate that, and I found you on LinkedIn, so
that's another great way. I'm very active on LinkedIn as well.
Right. So thank you, Eric, for being our speaker. On behalf of Connect Ship iShip, I would also like to extend our sincere thanks to everyone who attended today's webinar. And we hope you found the information valuable. I know I did. Remember that you can find a recording of this webinar in the video library on our website. And we hope you join us. Our next Reach webinar will take place Tuesday, October 9th at 10:30 a.m. Central. where we will be discussing ways for shippers to prepare for the upcoming holiday and peak season. So visit connectship.com to register and reserve your spot. Again, thank you, everyone. Thank you, Eric. Have a great day.
Thanks again.